And now more Operation Freedom with your host, Dr. Dave Janda, on Southeast Michigan's conservative powerhouse, Wham Talk 1600.
Welcome back to Operation Freedom, folks. I'm Dr. Dave Janda, broadcasting from an ancillary freedom bunker linked to Wham Talk 1600's Freedom Bunker in the People's Republic of Ann Arbor. This broadcast is solely occurring because of the brilliance of Derek Stone. For those of you that were with us at the beginning of the show, the deep state decided they were going to take us down. They were not going to let this broadcast happen today. It's a live broadcast. They decided they were going to take us down. And my first guest, TraderStef, well, I guess she could hear me, but I could not hear her because, well, the deep state decided they were going to kind of try to blow this whole thing up today. Well, Derek stopped that. He prevented it. And I decided we got to bring Steph back and have her in our last half hour. The segment I was going to do on Ruth Bader Ginsburg and what might follow, we're going to do that this week, probably on the YouTube channel, also back on this radio show next Sunday. I also have a more in-depth insight for our subscribers at davejanda.com that I will going into. In fact, I've already to our subscribers sent on Friday night after it was announced that Justice Ginsburg had passed. They announced her passing, that I sent a memo to all of our subscribers about the situation. And as I understand it, the person who is near the top of the list who could well be getting the nomination, I'm going to be going into greater depth in our WTF show this Wednesday. For those of you that value freedom, I ask you to go to our webpage, davejanda.com, and go to the sponsor section. Without our sponsors, this radio show, and also without our subscribers, this radio show, our YouTube channel, and the website, davejanda.com, would not exist. There are many companies that speak about freedom and their support of freedom. When it comes right down to it, they talk the talk, but they don't walk the walk. Every one of our sponsors not only talks the talk, but walks the walk for your freedom. I encourage you, at a minimum, go to the website, davejanda.com, go to the sponsor section. Go to each one of those sponsors, email them or call them, and thank them for their support of this freedom-based platform. But every one of these sponsors are the best in their respective businesses. I encourage you to support them by purchasing products or services from them. The Camino Company for precious metals, CaminoCompany.com. Numana.com for storable food and water. Knight's Restaurants, my comfort place. Whenever something good happens in the Janda family, or if I just need a comforting experience, I have comfort food, but I also have comfort places. That when things are a little rocky, where I go, because it smooths out the rough seas. And my place that I go to is Knight's Restaurants, knightsrestaurants.com. Hines Park Lincoln for automotive needs, Quick Lane of Canton, Stewart's Natural Health Pain Products or health products. Let me tell you something, non-narcotic pain formulas that are salves, rub-on, there is nothing like it. I got way too busy again last weekend, and actually over the Labor Day weekend 2 weeks ago, and put Stewart's right on, boom, right back to ground zero, no more pain. I encourage you, Stewart's Natural Health Products, Susan Blaze Insurance, and CryptoHippie.com. Also, we just put up a new video with Dr. Peter Glidden yesterday on Saturday about the role of calcium in your health and wellness. You can find that on our YouTube channel. It'll also be up on the website, davejanda.com, but also available along with the products on OperationFreedomHealth.com. A wealth of information that Big Pharma, Big Insurance, and Big Medicine do not want you to know about. OperationFreedomHealth.com. I hope you will visit every one of our sponsors and thank them. My next guest is someone who we tried to bring on the show in the first half hour of this show, and the deep state cut it down. But we're giving it another try. TraderStef initiated a career spanning 14 years within the New York City investment banking industry. Probably why they wanted to shut that interview down, by the way. Steph acquired a diverse skill set in human resourcing, technology and communication, training, education and development, business analysis, and global risk. She began investing in precious metals in 1999 while following market trends post-dot-com bubble in 9/11. And since then, Steph then left the banking industry in 2009 after 5 years in global risk management at Citigroup. Stef has developed and hosted a live Precious Hour webinar specializing in gold, silver, and the mining equities, combined with research of industry fundamentals, financial markets, global news events, geopolitics, and monetary policy, otherwise known as fusion analysis. She has a website. I encourage you to go there. TraderStef, S-T-E-F-F, is TraderStef.com. Stef, welcome back to Operation Freedom, I hope.
Hey, Dr. Janda, I'm back.
You're back. They tried, but they lost. Okay, Stef, let's get right to it, because obviously they weren't happy about you coming on. So let's hit it from the very get-go. Let's talk about the economy. Your take.
All right, I got a short story. It's got a beginning, middle, and end. You ready? Let's do an information download. So I'll begin with what is currently guiding our source of economic woes in the immediate future. It's the potential for a second wave with the pandemic, which is showing early signs of emergence since very late September, by the way. And its characteristics may not mirror documented dynamics from previous novel virus pandemics of the past, but its virulence has reemerged across Europe, the United Kingdom. Israel is now in a countrywide lockdown for 3 weeks. And with new countrywide and localized lockdowns currently taking place and more expected on the horizon. So there is one metric that's aligning pretty close to the pandemic in 1918, and that is, unfortunately, death. And in that only 7 months, the virus has taken just over 205,000 souls in the U.S. as of today, versus an estimated 675,000 over 2.5 years back 1918, 1919. So keep in mind, back then, they didn't have the modern medical system and medicinal advances that we're fortunate to have today, which is suppressing the death rate at this time, which is great. But the U.S. is currently averaging about 40 to 50,000 new lab-confirmed cases per day. And that's double the daily rate that we had during the first peak in the spring, and closing in on the midsummer peak as well. So the entire planet is now seeded with that Italian strain that created the epidemic hotspots that are characteristics of a herald wave. When a novel virus established itself while adapting to its new human host. So look, let's be clear. There's no gene sequence evidence at this time that it's any more or less virulent than it was since mutating in Italy back in February, which brought the herald wave to the east coast of the U.S., Western Europe, South America, Africa, et cetera, et cetera. Now, Eastern Asia is getting the first feelings of that Italian sequence. So if gene sequences releases in the near term show any consequential mutation, which would be a lagging indicator, by the way, we could be in for a rougher ride than we expected. So look, prior to the pandemic, the U.S. economy was doing okay, by keeping holes in the Titanic hull plugged with QE and fiscal policies, but still not outperforming where it was prior to the great financial crisis. That's over 10 years ago. So inflation in the stock markets and real estate, along with, the mainstream financial media, led average Joe to believe that all was well and Goldilocks was permanently in the house serving porridge. But, the economy's underlying fundamentals really indicated otherwise, like declining GDP, declining wages, declining industrial production since 1980, as well as the velocity of money, which has plunged to even lower levels this year than the decline since 1980. And there are so many metrics we could discuss and geopolitical issues that are just too numerous to mention. But of note are Iran and China that are most pressing and a growing concern. So what's likely in store for the U.S. in the near term? It's going to parallel the following 4 issues. Number 1, the pandemic in sync with the fall flu season. Number 2, an extremely partisan 2020 presidential election in the U.S. with a clear choice between capitalism and socialism. A leftist progressive political insurrection with a continuation of riots and soaring crime rates in numerous major cities that results in a growing lack of peace and security and confidence felt across the nation. I mean, Have you tried buying any ammo lately? Because your caliber is likely out of stock. I've had the same experience. And as of Friday...
And if you can find it, the prices are, like, off the charts.
Exactly.
Yeah.
And as of Friday, we have the death of Progressive Supreme Court Justice, Miss Ginsburg, I'm sorry. Mm-hmm. And that's a very big deal and a surprise on both sides of the aisle, at least happening before the election. So along with all the dirty politics that go with it, the timing of her replacement so close to the election is a major point of contention for some people, despite the constitutionality for a speedy appointment, no matter what day it is, adding to a highly partisan atmosphere on Capitol Hill with insurrection under the hood. Pelosi's even talking about another impeachment, and rioters want to burn the place down. You know, you just can't make this stuff up. So here are the potential repercussions. Unemployment skyrocketed to nearly 60 million folks following initial claims beginning in late March. And the rate of unemployment is still elevated. You know, we're somewhere between 10 and 15%, depending on what area of the country you want to focus on. Statistically, it's worse than the Great Depression. The current number of unemployed is roughly 30 million plus, with new claims just under 1 million per week, despite those job numbers having returned to the workforce, which, by the way, are not created jobs. As businesses attempting to get back to some semblance of normalcy are finding that those returning to jobs may not last long given the current circumstances, and many of those may mutate into permanence, like in the service sector of the economy or your local restaurant. So unemployment would have been much worse if not for the payroll protection plan, all wrapped up in the CARES Act, enacted by your Congress critters. And states and cities are planning huge layoffs in the near future because tax revenues are way down and there's lots of bills coming due. And New York City has even put their whole government on furlough for a week. So that's the beginning of the end. So the payroll protection piggy bank is drying up, and rampant partisanship on Capitol Hill has resulted in no clear path forward for any continuation or flavor in fiscal stimulus, including like maybe a little bit more mortgage relief or eviction relief for some renters. And the Fed has made it very, very clear that monetary support for the financial plumbing alone is a useless tool unless Capitol Hill utilizes fiscal policy to help create sustainable production, jobs, and consumption, because the virus, as they say, is steering the Fed's zero-bound interest and accommodative policy until at least 2023. I'm going to quote Jim Rickards. The idea that we're going to bounce back out of this with all pent-up demand is nonsense. We're not going to see 2019 levels of output until 2023 at the earliest. We're not going to see 2019 low levels of employment until probably 2025. We're not getting back there for 3 to 5 years. So we're looking at a long, slow recovery, and that's if things don't get worse from here. But they could, especially if we get a deadly second wave. And then, you thought I was finished, right? There's the issue of rampant deflation because of the pandemic, and the Fed really wants inflation, which is why they want to keep interest rates at zero. But now we're in negative interest rate policy because of a real interest rate, you know? And the Fed is planning to allow inflation to run hot beyond 2% if it can get there. We haven't been there since 2007. And some analysts think the sky's falling, that hyperinflation's coming, like it's imminent. But look, endemic inflation cannot happen despite unchecked money printing that debases the currency and destroys your purchasing power. Mm-hmm. And the stock market or real estate pricing can skyrocket because there's few investment vehicles available to provide any real return, you know? So real inflation will not take hold until the velocity of money gets off the floor and rises significantly. As it's been falling off a cliff since 1980, and since the pandemic, it's under the floorboards. And don't forget, 70% of our economy is dependent upon consumer spending, buying things, money exchanging hands. That is what velocity of money represents, how fast a dollar exchanges hands. So inflation is going to come back when the consumer gets confidence. Probably won't take a year or so. And then all the money printing sloshing around, you know, we can just hope that we don't fall into some kind of hyperinflationary scenario. The Weimar Republic's infamous bout of hyperinflation in the 1920s didn't begin with the central bank money printing or war debt and its stock market's rise. It began in earnest when the consumer regained some confidence, spent their cash, and that accelerated as the currency began losing value faster than consumers could spend it. So they spent it even faster, and the rest is history. And lastly, one more quote from Jim Rickards. Inflation will come when people lose confidence in the dollar and suddenly dump dollars for any hard assets they can find. Money velocity will accelerate, but it won't be into consumer goods. It'll be into hard assets that hold their value over time, like gold or silver. In other words, the best leading indicator of inflation won't be found at the grocery store or the gas pump. It'll be found in the price of gold.
So, folks, we're speaking with TraderStef, TraderStef.com. So, Steph, take us through. You did an analysis that you sent me of the U.S. Mint American Eagle coin sales, gold and silver, from 1997 until now. Educate our listeners about your analysis, because that actually dovetails into what you just spoke about.
Yeah, I mean, basically, without getting into too much detail, this interview will be posted on my website probably late tonight or tomorrow, and you'll be able to see that chart that I provided. But it basically says that smart money, not necessarily institutional money, but, you know, some smart average Joes out there see something brewing, and sales for bullion coins at the U.S. Mint, that's what I'm using specifically, the U.S. Mint statistics, tend to pick up about a year before a bear market hits a low. And then it really doesn't peak until maybe a year after a bull market really gets running. And then it slowly rises until it hits a higher peak when we get to the top of a bull, and then it starts to trail off. And then when we get near the next bear low, it starts to pick up again about a year before that low is put in. It's very interesting. But now with the year 2020, I'm going to jump forward. You know, with all the lockdowns and the mint shutting down, so that was a supply issue getting out to the retail buyers and the wholesalers, we're probably seeing only like maybe 50% of the actual demand that would have been sold out there versus what was available and actually occurred. So we've put in about 20 million 1-ounce silver American Eagles thus far. It's probably closer to, you know, the 30s or near 40. And with gold coins, 500,000 1-ounce gold coins. And in total, because you've got the tenth, you know, the half ounce, and I think the 3/4. So total in ounces was 627,000 ounces. And we've hit much higher peaks, like back in 2011, of 1 million ounces total. And we were around 47 million 1-ounce silver eagles back in 2015, right at its bear market low.
And so when you step back and look at this, right, about the purchases,
yep.
Where do you think things are going to be? If the next data point, let's say on your printout, where do you think things are going to be a year from now?
Yeah, it'll be suppressed this year because history, you know, what's done is done, right? You can't replace it. They can't print enough to keep up with the demand to match what it may have been. So I see a pickup next year. I have no idea what it's going to be. I can't say it's going to be more than previous peaks or maybe closer. You know, time will tell. But it'll definitely be probably higher.
And give us your take, your technical analysis, because many people are always interested in your technical analysis on gold and silver and where you think where we are with that.
Well, we gave some out there back on August 2nd, and that turned out to be pretty prescient. On August 7th was when we began to pull back, and I had mentioned during our August 7th interview that we really needed that pullback because anything that runs really hot, really fast, you know, it tends to, you know, the pullback to consolidate and get its mojo back is going to take a little bit longer, and that's where we are. We're in a chop and consolidation on the gold chart, and it's starting to show. I mean, it's been putting in higher lows ever since we had that craziness in March with the peak pandemic fear.
Right.
But it's making good progress, and we're stuck. We went back and we tested that 1920 all-time high, which was really important. I actually said I preferred to see that
Yeah, you did. I have to say, you did.
And it's when you look at the candlesticks, it's been closing and opening right along that line ever since March. So that has turned out to be a very good level of support. And with everything that's going on, I talked about previously, I think the fall season bullishness is probably going to start to come home to roost sooner than later. The Fed meeting was like a no-burger. They didn't say anything that they had not already said. But gold or silver didn't fall either. It's just steady Eddie. And as far as silver is concerned, well, back to gold, I talk about those Fibonacci extensions on August 2nd. And we actually went up and hit the first one, which was right around 2050. 2048 is the actual number. But we went a little bit higher, and it was overbought. It had to pull back. So the next level after that, if and when we retest the 2050 area, is going to be 2127. Can't tell you the time frame. If we talk about silver, there was a real beautiful pattern that's called a Swiss stare. And what that differentiates from a regular stair step is that the distance between the steps mathematically are almost equal to the dollar when you look at a chart. And you can see how that occurred when we broke out around $19 back in mid-July, and then it ran up to that 2150, 2149 level that I had been drumming the drums about for a few years. And then after that, it's just been a steady rise. But we've been in that chop since, September? And there's a Fibonacci confluence, these Fibonacci levels, where two of them kind of come together and squish like a sandwich, tend to be a little bit more resistance than if one was just alone. And that's what you're seeing on the silver chart. And we're just chopping along straight across. Support is like right around 26 even. And it is putting in higher lows. Not by much, but it is putting in higher lows since early August. But it's also putting in lower highs. So there's a number that we need to take out, like right around 28-ish, between 28, 28.50, then go back and retest that 30 level to get beyond 30. So that's what I'm looking at in the near term. And on both the charts, gold and silver, the volumes have been falling off, the buy and sell volumes, as it's been chopping and consolidating. And that's very positive because that tells you that a shift in trend and momentum is imminent. Maybe Ginsburg is the trigger. We'll see.
Interesting. So many people that would say when you see a diminished volume, some people would say, oh, well, that means there's not any interest in it. That means it's just going to lay fallow and just, forever, just chop around forever. That's not your take based on your chart analysis.
No, not necessarily, because it's dependent upon the pattern. Different patterns have different outcome dynamics that are possible with the volume dynamics that go along with it. So with some patterns, increasing volume will verify that pattern that it's, say, breaking out to the upside or breaking to the downside. But when you get this kind of chop going off to just straight across and volumes are falling in both buying and selling, that tells you that a shift is coming soon.
TraderStef, how can folks follow you? They need to follow you.
TraderStef.com, and that's with one F on the end. And you can follow me at Twitter at TraderStef. Be safe, everybody.
Steph, I'd like to thank you for everything you have done, are doing, and will do. And I'd like to thank you folks for joining us today on Operation Freedom. Until next time, Dave Janda signing off. Dream big and dare to fail.